getting ready to crash. And I think it's going to go down 40% down to from 6,800 all the way down to 4,000. Gold. So the market crashed. Well, it crashed and then it flattened out, but basically you had zero growth. I'm waiting. I don't know if I'll buy here in early December or not, but I'm definitely going to buy this next dip. But I think the bigger dip is still coming. Like I said, $3,700 gold. I think that'll be a really good area, sub 45 silver, to buy that dip.
Market analyst Don Durrett outlines a scenario where the broader equity markets appear increasingly fragile as momentum breaks down and liquidity tightens. His view is that a deeper corrective phase is forming beneath the surface, with the potential for a 40% drop from recent highs. In this environment, he expects gold and silver to experience a sharper pullback before resuming their long-term bull trend. Gold retracing toward the $3,700 zone and silver slipping below $45 would, in his assessment, represent high-conviction accumulation levels, similar to previous moments where structural demand eventually overwhelmed short-term volatility. His perspective reflects a disciplined, cycle-based approach. Avoid chasing overextended price action, let the market unwind, and position into fear rather than momentum. With global debt pressures and capital rotation still supportive of precious metals over time, the coming dip may be one of the few opportunities offered before the next leg higher begins. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
You can see for 7 years, basically, it did nothing, zero. So it went down and then it tried to come back up, but it never got a new high. So basically, so that's what about that. This is what is going to happen here very soon. And when this happened, when this sell-off happened, so you had the dot-com bubble burst in 2000, and you had 9/11 in September of 01. That was the beginning of a bear market in the S&P. And when that bear market happened, the miners did extremely well. And so that's what we're seeing here. We're getting ready to see the S&P roll over and crash, just like it did in 0001, getting ready to crash. And I think it's going to go down 40% down to from 6,800 all the way down to 4,000. So we're going to see a repeat of that. And then gold. So the market crashed. Well, it crashed and then it flattened out, but basically you had zero growth. So you're waiting for a new high. You just never get it. And so the money rotated out of the stock market and it rotated into the miners, and the miners did extremely well. Like I said, 800% return on the HUI during that period. It was about 100% per year. And we just had 100% move, actually a little bit better than that in the HUI. The other thing that's really important here is gold. So now we have to bring in the gold chart. Gold went up 240%. So it went from 265 January 01 to 900 in 08. That was a 240% return. So that's kind of what we're going to see here. We're going to see gold go up, but the miners do much better, right? So gold's going to go up. I don't know. I think a minimum is 6,000, but yeah, you can see gold going up. There's gold, the green line.
Yeah, gold's the green line.
Yeah. So there you go. So gold basically trended up, and the miners, now the one thing that's interesting here, the miners did better than gold, which is what we expect them to do. The miners did better than the S&P, which is what we expect them to do. So this is the correlation. And again, the one thing that hasn't happened yet is the S&P hasn't crashed. And I said that, there's three things that we have to happen before, as gold and silver miners, before we really, kind of get excited here. Now, the first one was the breakout. It's actually four things. The first thing was the breakout in gold, and that happened actually all the way down to December of 2019. You can call it January of 2020. It's when gold broke out. And then silver, it didn't join the party until 2020, but then it was kind of a false breakout. And then the real breakout really was in August of this year when it got above 40. For me, I've been doing this for years and years. So I basically have been building my portfolio. I don't trade. I don't get out of the way. I used to do hedging where I would basically, try to protect my portfolio a little bit, but I don't do that anymore. But I experimented a little bit with it. It's not easy because basically the only really good way to hedge is to buy options, and options are very risky. And you have to time them. You got to know when to get in, when to get out. I tried it. I didn't like it. Basically, it's stressful. And so I don't hedge anymore. And so I just ride the train and ride it to the top and buy dip. And I bought the last dip early October, mid-October, early November, late October. That last big correction in gold, I bought that dip, and now I'm waiting. I don't know if I'll buy here in early December or not, but I'm definitely going to buy this next dip. But I think the bigger dip is still coming. Like I said, $3,700 gold. I think that'll be a really good area. Sub 45 silver, to buy that dip. So that's my answer.
Market analyst Don Durrett points to a repeating cycle he believes is now unfolding across equities and precious metals. He notes that, much like the 2000 and 2001 downturn, the S&P is setting up for a central rollover that could drive prices down toward the 4,000 level, roughly a 40% decline. In the last comparable cycle, capital flowed aggressively from falling equities into gold miners, producing an extraordinary multi-year run and gains exceeding 800% on the HUI. Durrett expects a similar dynamic ahead, with gold advancing toward the $6,000 region while miners outperform even more strongly. Despite the volatility, his strategy remains straightforward: accumulate on weakness, avoid short-term hedging, and wait for the deeper pullback he anticipates near $3,700 gold and sub $45 silver before the next significant advance begins. Let's get into the interview.
Silver had a hard time joining the party. Then the third thing that we needed was the HUI. And the HUI and silver, the HUI kind of broke out a little before silver, like April of 24. We had those problems in the market. We had basically a big breakout in the HUI. And then because the HUI was a little early, but until silver joined the party, those three weren't kind of at levels we were happy with, we were excited about. So everything kind of turned for silver and the HUI in August. So we had three leg working. So everything's working. And there's everybody's kind of coming into, not everybody, but a lot of retail is coming into the miners in August. You showed that chart earlier where basically the HUI just ripped higher in August.
Yep.
So the last shoe to drop is that S&P, which hasn't happened yet. So I've been saying, look, this is great that we got a bull market here in the HUI, but since the S&P hasn't joined the party yet, we have one more event that we have to fade as investors. And what I mean by fade is that we're going to see some corrections. And I was warning people, expect a 20, because when we had that breakout in August and September, I was warning people, get ready for a 20 to 30% correction in your portfolio. And that's exactly what happened. The HUI went down 22%. Gold went down 12%. And you had that 20 to 30% correction in your portfolio. And now that was going to happen, but the bad news is the worst isn't over yet because the S&P hasn't crashed. And so we're waiting for the S&P to crash. And when the S&P crashes, that'll be an even bigger dip. Today was a good example of what I'm talking about how these miners have some serious headwind to the S&P. You got to keep your eye on the S&P. The HUI was down 26 points today. Yesterday it was in great shape, 620. And today it's down under 600. So in one day it went down 26 points. SILJ went down 5% today. And we're talking on Thursday, November 20th. And the reason why is because the S&P went below 6,600. And I said in November, gold and silver and the miners are going to follow the S&P. If the S&P can stay above 6,700, can stay above 6,800, gold's going to retrace back and maybe go all the way to 4,300 in November. But if the S&P has any weakness at all, gold and silver and the miners are going to get hit. And that's kind of what happened today. The S&P was down like 0.5% after the NVIDIA earnings. We can talk about that because NVIDIA can no longer hold up the market. A lot of people are bullish silver, saying, oh, silver's going to go back to 54 or higher here. And I'm like, slow down. It's not going. I doubt that's going to be the outcome. It's possible. But what's more likely is silver's going to get his head ripped off. And I think silver's going to go all the way back to 42, 43 when this crash comes. I'll be happy if it sticks at 46, but I don't think it will. Today, it's holding $50, which is great. But when the S&P decides to go, you could go down to 47 in one day, easy. And then you're looking at, sub 45 and you're looking at 42, 43. So we got that one more event coming, that crash. But the good news is this is the begin. This is what always happens. You get the crash, everything goes down. But then what we saw in 2000 and 2001 and 2002, we saw gold and the miners get a bid when the stock market couldn't. And that's exactly what's going to happen again, I believe. And I've had this thesis for 2 years. It's just playing itself out now.
Market commentator Don Durrett explains that the precious metals cycle is unfolding almost exactly as expected, with gold, silver, and the HUI already confirming a primary bull phase, yet still missing the final catalyst. He notes that silver struggled to participate early, while the HUI broke out ahead of it. By August, both were firmly aligned. Retail flows surged into miners, pushing the entire sector higher. However, Durrett emphasizes that actual acceleration won't begin until the S&P 500 completes its long overdue breakdown. Recent action, sharp miner pullbacks triggered by even minor S&P weakness, shows how tightly metals remain tethered to broad market risk. He expects one final washout, potentially pulling silver toward the low 40s dollars, before capital rotates decisively out of equities and into precious metals miners, just as it did in the early 2000s. The setup, he says, is nearly complete. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.